There is a substantial risk of loss associated with trading forex, binary options, stocks, or equities, collectively, asset classes. Only risk capital should be used for trading. Trading in any asset classes is not appropriate for everyone. Past performance is not necessarily indicative of future results. No representation is being made that investors will make profits or will not sustain losses. Before trading in any asset classes, investors should consult with their professional broker, financial advisor, or financial consultant to determine whether trading asset classes is appropriate. Investors who trade in any asset classes should only do so if the capital used for this purpose represents funds that an investor can afford to lose without adversely impacting the investor's lifestyle. No trading strategy or methodology is without risk of loss. No trading strategy is risk-free, and no trading strategy can guarantee profits or freedom from losses. Investors risk losing the cost to execute any transaction, including associated commissions or fees. You should carefully consider whether trading in any asset class is appropriate for you in light of your investment experience and financial resources. Any trading decisions you make are solely your responsibility and at your own risk. None of the statements or materials in the Auvoria Prime chat rooms constitute a solicitation or recommendation to buy or sell.
Welcome to the extended forecast. It is encompassing the last 3 weeks. Been off the microphone. Got a few changes going on here, but plan on being at the mic at least once every 2 weeks for the Auvoria community. That's what we've sort of decided on here. Just to go through and just give you guys an update and so forth. Just been real pressed for time, and we decided to move my casts essentially to every 2 weeks approximately. So I'm going to try and get them done on Monday. And honestly, a lot of the stuff that I've gone through, especially if you guys want to take a closer look at, more salient calls, at least from a macro perspective, I'd focus on much of my conversations in January of 22. If you are, students, clients, advisors, you want to talk a lot about, how I believe when you get into this role that if you're going to be making prognostications, which is a futile endeavor at best, that you should be time-stamped to be able to prove it, right? So that's kind of that. One piece of housekeeping, if I may, actually 2 pieces of housekeeping. Selfishly, the book is out, ladies and gentlemen. So, as some of you may know, Steve, my partner, and I have been writing a book really about just entering and bringing in a new piece into the mix. We've spent a fair amount of time on this book. It's available on Amazon. The book is more like in workbook form, which I find interesting. We got our copies from the printer last week. Really proud of this work, and I think that it must be catching on. So if you guys do want a copy of the book, you've got to send me an email, okay? And I can email a copy out. We've got a real high definition version up on the cloud. We can send out the file, so forth. Surprisingly enough, this file is not over 25 megs, which I think it would be. But I can actually email the file to you, so you can send me an email if you want. It's just Steve at firstdownfinancialinc.com. I think many of you have seen this before. So the email address is right here. And this is probably not the easiest to see. Steve at firstdownfinancialinc.com. The other cool thing is looks like there's been a bunch of people nominating me this year for the Investopedia Award, which I think is kind of cool. So apparently I got to go in and do some sort of application, even though there's been a bunch of people letting me know what's going on and all that. So that is that. Do keep in mind that with this book, it's really just introducing a new asset class. There's been multiple Nobel Prizes awarded on a lot of this in financial theory and all that. And we're talking a lot essentially about just operating in what's called a wise retirement. So let's go into the calendar. I want to take a look at last week. So the reason I'm going backwards in this discussion is I want everybody that's taking a look at the screen right now. This is last Friday, okay? So from a big picture perspective, we had a 0.6, which I consider to be quite hot, core PCE. And keep in mind, this is a lot of industry stuff. This is like what I like to call the retail crowd, not institutional, but it differs from core CPI in that it only measures goods and services targeted and consumed by individuals. So they're but the Fed has said point blank, this is their big focus. I mean, this thing came in hot. So, I mean, you've got a lot of the markets, which got pretty battered on Friday, no surprise. I think the markets had gotten a whiff of this and moved into this as we had many new clients coming on board the last couple of weeks. We've been telling them flat out that we see equities taking a big dive and that we just don't want to be on board for the train lower. Okay, so the grand scheme of things, it always sort of boils down to, and I've got all kinds of pictures up on the screen, but what does it mean? So stock market, the bears ended the week with bloody hands as indexes fell once again. Nasdaq lagged all other major index, sliding 1.7 last week. No surprise. You booked a loss for the entire week, so the indexes they undercut their 200-day moving average last week, and I'll go into some of the charts here. Just have the daily based ES, which is the E-mini S&P 500 chart on the screen. You can look at this as a proxy for the S&P, vice versa. But essentially, the S&P 500 closed off the lows for the day, but it still fell 1.1%. It also lost 2.7 for the week, and has now lost ground for 3 weeks in a row. So as I had mentioned in January, and really this isn't about taking a victory lap, it's for helping you guys reduce risk in the portfolio, act like an institutional investor, all that fun stuff, just like we do here in the office. But we're down 2.7%, and gains for the year, this is the important part, they're now below 4%. So index managed to find support just above the 200-day moving average, but fell below the 50-day line. Okay, so albeit barely. The grand scheme of news is that everybody's got their eye on that number, right? So that the pressure into the marketplace of Jerome Powell now is, there's just too much gray area around this. I can't even begin to formulate an opinion. Obviously I must based on that. I'm not going to get into the nitty gritty, but I'll show you guys a lot of how I'll just peel through a lot of research, a lot of the people I follow on Twitter, obviously from the blog spot accounts that I've shown you guys. You can go through all that as well. But we're in a quandary, if you will, in that prices are coming off their highs, right? I guess you could look at it from the perspective, and I hadn't really thought about it until just now, but prices, like here, I'll give you an example. So if you look at the Baltic Shippers Index, I don't have it on the screen, but that thing has just come down an absolute ton. I think it's what, $2,000 to ship a container now? It was close to what, 12,000 at the high. So prices are down 82%. Now, granted, a lot of this was pandemic, with supply chain stuff, but many experts out there across all kinds of sectors that said, well, look, I think a lot of these shipping prices are going to stay artificially high, right? Which would have increased costs dramatically for a lot of other stuff. They're back down to where they are historically. So from the standpoint of costs to ship, nat gas prices, I don't care if you're looking at the US based gas prices or if you're looking at, here, I'll give you guys an example here, what's called the Dutch TTF. We sort of monitor this because we own in client accounts a royalty trust that generates just some phenomenal income, but it's based upon the Dutch natural gas calendar. What happened here? Why did pricing just went weird on me here? That's too wiggly. All right, here we go. Right. So as many of you saw, this just related to obviously the invasions into Ukraine, but look at how much prices have spiked natural gas. Now, this is a small subsector of European energy consortium prices, but but the pundits were expecting it to stay in a range like this. We're all the way back down to where we were before, right? So it took, arguably a year and a half to get back, but it's sort of come back down. Now, I oftentimes will run off on tangents just to sort of make a point, but I mean, between costs of energy, shipping costs, and obviously we could dive into 1 bazillion other raw materials costs, they're all coming down. But the interesting thing is that anything related to retail or the Fed looks at as the everyday person, we just call it retail. Um, they have full employment, they're out spending money. So prices are going to remain high, and for what it's worth, and this is almost a bullish argument, quite frankly, but if prices remain in much, much lower costs to make raw goods, have services, shipping, transportation costs, right? But the prices that they're charging for them are still artificially high. Now, eventually, capitalism irons out all wrinkles in a perfect scenario, right? Can't say it's been running that great, but it's running much better than it has in the last 2 years. It will begin to iron out the inefficiencies in the system just from a supply demand standpoint based upon, um, technology and innovation, all that fun stuff. So, the argument would be like, wow, some companies, they're still charging a lot for these products, but their costs are coming way down. So that means that their gross margins on this stuff is going way up, right? So again, just, this isn't necessarily a canary in a coal mine, but I just want to alert you guys to kind of what's going on with this and understanding that. So let's go through let's take a look at this week's news. So, obviously most of the stuff that's been dominating the headlines in non-business news, and if it's going to affect a potential business, I usually pay attention. The vast majority of non-business news that isn't impacting it in some way, I typically don't pay attention to it. I frankly don't have the level of patience for the mania. I don't have the level of patience for a lot of the fakeness that's in a lot of this, and so forth. It's as I joke, I just choose not to use the bandwidth on it, right? As a joke, we were at some party over the weekend, and one of our friends brought up I guess some particularly negative event that happened to them in high school, and they had a chance to confront that person again, and they were wondering, what do they do? And this came up in discussion. Somebody asked me about it. I said, why on earth would you ever give anybody the luxury of knowing that for the last 20 years you've been living in their head rent free, right? And after I said that, everybody's like, well, that's probably a good thing because, just don't give them the satisfaction that you were paying attention to it. And I was thinking, you know what? There's a lot of people that just, it's all living in regret, right? And I was thinking, the regret is single-handedly one of the more destructive paths to trading, right? Regret leads to all kinds of things. FOMO, gunslinging, trading, trying to climb out of some hole you're in. As I always referred to in the past, some of the best traders out there, frankly, aren't necessarily the smartest or the dumbest people. They're the ones that have learned a process, and they repeat it over and over and over again. And I would think that yes, they've had losses, some much more than others, but then have been able to change their process up, and they do not live in regret, right? And I'm not speaking for the planet, but I can probably tell you that if the vast majority of the people stopped looking in the rearview mirror, right, in whatever situations they regretted, and they just chose to learn from it, we'd move forward as a society 10x of where we are right now. And the same thing is applicable to you as a trader. So maybe the theme of today's discussion is let's not live in regret, right? Now at the same time, at least from a trader's perspective or a portfolio manager, don't have your head in the sand either, right? My dad used to joke, if you make the same mistake twice, you're not a veteran, right? It's just kind of like learn from your mistakes, don't dwell in the past. Essentially just been learned from it, right? But we all have made the same mistake twice. But especially in trading and in understanding the markets, I can't tell you how many people I've come across that continually do the wrong thing and expecting a different result, right? It's a definition of lunacy, in my opinion. So, that is my tangent for the week. Let's take a look at the news here. Consumer confidence. I would imagine this is probably going to come in hot right here. It's tomorrow morning. Governor Bailey speaking, Bank of England. Take a look real quick at currency prices and we're done. Well, there's not really a lot of news stories this week. And, it's probably a good thing because the market needs to digest some of what's coming out. As far as the currency land, I think it's, we're looking at weekly charts here, so I'm trying to stay real macro on this, but we've had dollar ripping essentially all the way up into the highs, right? Was just an absolute monster run as global assets sought the least of all evils, right? Still an evil, but it's the least of all evils until it wasn't. And then everything changed, and obviously there's lots of changes in both treasury. I'm not going to get into what's going on in credit markets. I've covered this exhaustively in the last couple of episodes. But as far as the DXY, we're climbing back, and I showed the range, which I don't have a profile chart on, but you can see a profile chart in the Euro US dollar here. And even though this isn't perfectly correlated to the DXY, it's close. But as this is an inverse correlated chart, you can see, but it stopped going up, it started going back down because of, you could see that it was the top of the range for this zone that we've been in. So during this whole period of time, the value area low was standing essentially in that range, and it reversed right off of that as we came in. So you see, as I come in, it brings different data into it. I typically want to see the entire data, at least on the weekly chart here. We're going all the way back to 2018, which, arguably is a long time. But you can kind of see where the value area highs at the blue line here, the value area low over that period of time. We got away from value much outside the price, and now we're back inside it, but it's probably going to hold here at this value area low, which is a long-term support area from a perspective of just an aggregate of volume that you see here. Now, I don't want to do a deeper dive, just keep it light today as far as just, real just touch and go analysis on this stuff, but if you guys want to look in a little bit of a deeper on this is Linsoft's websites, just the S&P. These are daily chart of but essentially it's an aggregate. It's a little bit different. I found with people really don't want to get too much into trading, which is probably most of my audience, that they just kind of want to have an analysis. I typically don't show these charts because there's just way too much stuff going on. But essentially it's just taking an aggregate of where all the prices for a particular averaged in, right? And that is a very, very powerful point for support and resistance. So DXY, the argument now is, well, where does it go from here? And if you just jump back to a daily chart, we'd stay somewhere in this bottom zone, as I've been talking about for a while. We're going against the upper part of that, so I would expect to see some pressure pushing against us back down inside the range. Let's take a look at GBP, the other big one. Again, this is a daily chart, but you can see how the range that we're in near the highs has just totally capped this movement. And arguably, you'd really probably want to get rid of this top range right in here as far as data set. And you can see when you remove most of that data and you just include us trading in this bottom range, look how tight price has been against the value area high. It is, as soon as it came up against the high, and arguably right here, this may not have been the high, but now as we come back up against it, it is unwilling to break out. So when that is the case, it argues for just a sideways trade within a particular zone that we're hearing here. You notice it's center line based, and then your highs, we're trading, quite nice inside that zone. So for a lot of Auvoria's bots, the idea to short the high if you're on a longer term play, swing trading this stuff, take trades around the center line or point of control. There's obviously a whole bunch of areas of confluence of other stuff lining up there that would allow you to take that trade there. Bitcoin, I think probably someone was sounding the bell up here. It's been overly bullish on social media. Not near the exposure that it had in the past, right? You would think that if something went from 17 to 25 is about what the magnitude of this move was, you'd have a lot of social media just dancing in the streets, and they're not. And it is completely, at least from my perspective, kind of what I thought. There's a lot of people just got absolutely blown out, and they just either hung it up or they got margin called or whatever the case may be, and they weren't on board for this, other than the hold on for dear lifers. And if in fact you were one of those individuals with excessive amounts of your money in this, I would have highly suggested you take some off the table up here, as we're probably going back down. If we go back down again, I doubt this area will hold. Again, not an expert on this. I could be wrong, as I say all the time. Use me as your Jim Cramer, right? It's your high odds or your inversely correlated dude. So that's pretty much all I wanted to cover as far as just main top currency, see what's going on in energy. If we do a cast next Tuesday, what I would suggest is I'll cover a little bit more on the credit markets, let you guys know we are. But as far as long-term charts for essentially what's going on in credit, which is excellently represented by the 20-year Treasury TLT. This is one of the most liquid instruments on this planet. It's just massive volume on this every day. So it's a really good way to understand kind of what's going on with bond prices. It gives you an idea with what's going on in the credit markets, right? What are the loans doing on anything? Obviously, we know the cost of capital is going up higher, but how or what does this foretell for what's going forward, right? I would see this as headed back down somewhere towards the nuts. If not soon in that path, it's going to stay probably tight here and probably pop back up. Maybe try and find prices. We're on a weekly chart here, so this is really longer term stuff. In case you guys need any assistance, feel free to send me an email. Always happy to help if time provides. But other than that, wish everybody a good week. May the trades be with you. This is Steve Vettel, 27th of February. Off the mic.